Guys, let's go ahead and start at 8:30 right now. So we're starting on time just to make sure we cover a few topics on the volume profile, along with preparing for this week. Even though this week might not offer a lot of volume and a lot of volatility, just because it's kind of towards the end of the year. So that's to be expected, right? Not a lot of hedge funds are sitting around middle of or end of December looking to make money. If they have made money, they'll keep it, and if they haven't, they will not be risking it. Going into the new year potentially with some changes and global risks that are kind of pending right now. So that being said, I'll go ahead and start sharing my screen here, and then we'll get going. So many of you that that've been here, I've started this kind of PowerPoint that's kind of the base for the volume profile, along with a few other topics that we cover in our Discord. There's many other things that we've covered previously, but this is kind of the main focus is the volume profile. We also have a PDF for the orbs. So the orbs are not part of this class, but we can hold one off to kind of cover it. So when you think of the stock market, a lot of people that I've seen in this course don't educate people about the market auction theory, right? The way it works is basically the buyers and sellers. So the buyers and sellers, if you want to buy something, somebody's got to be willing to sell it to you. And if that does not happen, the price is not going to move. Usually, the markets spend a lot of time in balance, means they're in equilibrium. People are happy, they're buying and selling at the prices that they're okay with. But then something comes up, whether it's new information about the company or whether it's buybacks or whatever the information might be, and how it's going to be perceived by the market, as you guys know, sometimes it's predictable, sometimes it does totally opposite to what you believed it would. Many times you see companies have great ERs and then they dump it. Then you see bad ERs and they pump it, right? So it's the perceived, notion of the value and how it's calculated, and also the positioning and how aggressive the sellers or buyers are on the opposite side of that stock. So when you think about it here, right, you have the sellers and buyers, and when they're in efficiency, that means they're really in a balanced, which is represented here on the right. So you're basically trading in a range. Then the new piece of information will come up, and it causes an imbalance in efficiency, right? So whenever you have an imbalance, that means you're leaving the area where you're previously happy trading within. And then you have two things happening, right? Either that new balance that was created and new value area found, it's either going to be accepted or rejected. And that's why it's important for people to understand when you're looking at bigger picture, right? Like if you look at monthly volume profiles and you see a value area, right? And we experienced this live a couple of times when we had the watch lists and trading, it would go below the current month value area and it would bounce off the value area high from the previous month, and that was suggesting, hey, we're accepting the new value area. And that's what happens in the stock market. But it's literally price time sorry, the price and time that are important for it, right? And then you have the volume. So when you combine those three things, it kind of creates the whole auction theory for us, right? So there's balance, imbalance, acceptance, and the rejection, and that's what you should be aware about when you're looking at this slide. And when you think about stock market, it's literally like an auction. If somebody's not willing to take the price higher, well, somebody's got to be willing to, offer the price lower, 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 and there might be more demand in the lower prices. And same is true for the opposite. Okay. So just like I mentioned, you have the price, time, and volume. So that when you combine those three things, that's pretty much the value. There's a lot of new traders coming up with different techniques of trading, which is okay. If you can master a technique and it's repeatable and you can make money, whatever you want to call it. There's ICT. There's a whole bunch of crap that's available right now. And I'm not saying it doesn't work. It probably does work, but I promised you, when you look at it, it's always the price, time, and volume that's combined in any of those, and you can name those events however you like. But without volume, you're not going to move the price. Without price movement, price and bid and ask, you're not really going to get much volume if it's staying the same price. And then you have the time, right? Which is, the opportunity, some opportunities don't stay there for a while. So that's why you have to act, when it's reaching certain support or resistance levels, you got to be ready to act. And that's where the time comes in. The key point that you have to kind of remember here is the price discovery. So, the stock market, they use the price discovery to see when the price is in the fair value, meaning when it's in balance, if it will be accepted, if it will be rejected. That's something you guys got to start kind of looking at. And it happens literally in every time frame, from 1 minute to daily to monthlies to quarterlies. You'll see that, right? When the price is in the range and it's in the value, when it pops out of it, and if you look at, for instance, Amazon later on for your homework on a monthly, you'll see this, right? It was in balance for about 12 months on a monthly chart, and then it popped out of it, came back, rejected, and it continued lower. That means they were not accepting that price higher. There was no value above, so they're going to look for value below. And that's how they use the price to discover where the next value is. So, and I'll bring this up for new people. When somebody says there's a lot more buyers than sellers at a certain point, just stop them and correct them. There can never be more buyers or sellers of something. If I'm not willing to sell you a piece of gum, you can't buy more than what I'm willing to sell. If I'm not selling it all, you're not going to have the piece of gum. So people saying there's a lot more buyers on this level than sellers, that's wrong. And same can be said for a supply where they say there's a lot more sellers than buyers. That's wrong as well. They're more aggressive versus passive. That's true. So if you come up to a level and there's a lot of aggressive sellers and it becomes a strong high, as we call it, that means the sellers at that level really wanted to get rid of that equity or whatever that might be that they're trading. They wanted to get rid of it. So maybe they entered the order using market orders instead of waiting for their level to hit and then being executed through the market order and getting into the market. They use market orders to get into the market, right? So usually when I'm buying shares of something like I bought SOX and SDOT right there and then, so I became an aggressive buyer of that. In other words, I was an aggressive short position. So don't get it confused where there's more buyers or sellers. A lot of people are confused when they enter the stock market and trading. People tell them that, and I don't know if any of you ever wondered, but it's like, how can you have somebody buying more than you're selling? That was my always first question. Like, that's not possible. Like, if you go to a stock, you go to Best Buy. I mean, if they only have 5 PS5s available and you want to buy 10, I promise you're not going to walk out with 10. You're going to have 5, and that's what's available. So they're willing to sell 5. They had inventory of 5, and you bought 5. So that's how the stock market works as well. So don't get that confused in terms of more or less. And then when you look at these buyers, right, you have the aggressive and passive. So at key levels, right, if you have responsible buyers and responsible sellers, and then you have initiative buyers, initiative sellers. So initiative sellers are the guys that will take it down below the support and aggressively start selling. Initiative buyers are the buyers that will wait for something to come in at a discount price and start buying it. So if you think about yourself, if let's say you want to buy some lobster, and every Wednesday at your store, it's a sale and you can get it, let's say, for $15 a pound, and it's usually $30 a pound. At that point, when you come on Wednesday and you're buying at $15 a pound, you're going to be a responsible buyer. So basically, you're buying it on responsible way. You're waiting for that sale to come in and you're buying it. And if you're a responsible seller, when the price comes in to the high level, you're going to be looking to sell it. And then initiative buyers and initiative sellers, they're usually the one that drive the price further down or further up. So if the price is at resistance where you have responsible sellers selling, and if you have initiative buyers buying, right? So they might kind of be able to break that and go higher. And then for sellers, it's the same, but just opposite. Okay. So if you look at the tape, and a lot of you guys might not use level 2, I don't use it a lot. I do look at the book map on ES from time to time. Ninja trading platform has some cool features on the DOM as well. So if you do get interested in this, there's a whole, you could literally hold another class on this on level on L2 or L3 tape to see how it works, right? So when you think about, the auction theory, right? So then I don't know how many of you guys are familiar with this. It's literally like a flea market. So if the price is at $100 right now and there's 75, sellers there and 50 buyers, in order for me to move this price up to go to 101, I have to absorb these sellers right here. The 90 and 75 have to be absorbed. And you usually, when you look at the tape, you look at it diagonally, right? You look at from 50 to 75 and so on, right? So you can't just look at it straight because you'll never have that. Does this make sense on how the price would go up? Is anyone confused about this? And the same is true for price to go down. If I wanted to go to 99, then these sellers have to absorb all these buy orders here to push it down to the next level. And then you would see, where's the heavy selling. So if you look at this, 107 level would be really heavy. There's a lot of people willing to sell there just sitting on their orders. And just because it's sitting there does not mean it will happen, right? There's something called ghost orders. They put large quantities, and sometimes you're like, man, there's a huge seller here. It's a wall. And as the prices approaches it, that ghost order goes away, and the price just goes away. And that's basically, market makers manipulating the tape. So that way you guys are, us, not you guys, cannot tell what's going to happen or where to go short. So they would just erase that if somebody builds a really, strong short position and they just remove theirs and these orders kind of buy up to sell orders, then you're kind of screwed because you just got ghosted by a big boy. Does that make sense here? Because this can get complex, but it's really, really easy. If you want to go down, absorb the orders on the left. If you want to go up, absorb the orders on the right, and you move up. And here, just make sure that you understand this. There's no market orders on this, right? Why is there no market orders? Does anyone have an idea why?
Those get filled right away.
Yeah, those go filled. They're not passive orders. So if you're entering market, you're not going to show up on any of the prices. You're willing to take the best spread available. In this case, in this scenario, it would be 100. So you would not be waiting a limit order buy, limit sell. You're just going to get what's best available. Okay. So market orders are not part of this, and that's why sometimes when the stock gains momentum and retail starts hopping into the momentum, even if small quantities, but a lot of people, they're able to drive the price from 100 to 101 just based on the activity, excuse me, and how they're executing the orders, right? And usually retail is more of FOMO, so that's how they're able to kind of fake the price and then till they reach a level where, the hedge funds are sitting and waiting to sell. So the exhaustion on the tape, that's also, if you guys start looking at it more, you'll be able to kind of notice it more frequently. This is also visible on Bookmap if you're using Bookmap on ES. This is highly visible there. And then if you have L3 by NASDAQ, or even if you just use level 2, you'll be able to notice this, right? So here, if you see the large imbalance in price, right? So not much selling orders up until kind of like 105. So if there are not a lot of sell orders, but there's aggressive buy orders, what would you expect the price to do here?
Push up.
It'd be a quick push, right? I mean, it would be almost like, hey, you have these 2-3 buyers here that would pretty much exhaust the sellers up until 105. And then, if you take the sum 5 here and the sum 5 here, it would be a really big difference, over 100% difference probably in the order quantity, right? That's sitting there. So usually when there's an exhaustion on the right or the left, right? So there's not a lot of, if you flip the picture right here and if you put these numbers here and aggressive sellers here, you'd be able to notice that there's probably a high chance that we're going to be dumping here and rather quickly if the picture was kind of flipped. Does that make sense? It's important for you guys to understand this just because it can help you validate when you're at a key level at a demand or a supply. if you're at a key level of demand and you see people sitting there with a lot of orders, it's not bad to jump into that trade. If you see people are aggressive and they're buying and you compare the time and sales and you're seeing them buying, that validates your, the L2 tape. And then you'd be like, okay, well, they're buying. I'm seeing, time and sales, and I'm seeing them buying them these orders and they're still coming in. It's not a bad way to get in. And if you're looking to short, if you're approaching like a key resistance point, you want to see some selling, passive order sitting there, but then also on time and sales, you want to see some aggressive selling, and that would help validate that level, well, at least the side that you're trying to hop in and take a trade. And just keep in mind, a lot of brokers give you L2 free, meaning not Robinhood. I'm talking about like Thinkorswim, Ninja platforms. They will give you some level 2 data free, and they only show you 10 levels, 5 up, 5 down in terms of, the L2 tape, what you're able to see. You can purchase additional L3. I would say it's not really needed and you're going to be wasting money, but it does exist where you can see the whole passive, all the limit and passive orders on the price of that equity or whatever vehicle you're trading. You'll be able to see the prices kind of where they're parked, right? Because there's, for me, I still have an order for Apple at 95. So if you look at L3, there might be a little circle there, a couple of hundred shares for Apple at that level. So that's how you can use L3. So and hopefully you guys are familiar with this, right? So when you do the market orders, like I mentioned, that's the most aggressive buy, right? You're doing the best bid ask. If you're not familiar with trading options, and at least if you're trading SPY, Apple, and highly liquid stocks, and you're trying to get in quickly into the market and quickly out, market orders can be used, right? Otherwise, I don't suggest use market orders and options. You will be punished if you do. Then you have the limit, the stop and stop limit. And from all of those orders that you see here, you can have, the limit buys, the limit sells, the stop buy, stop sell. So you can have a lot of different types from here, the buy and sell. So for each one, you will have 2 options, right? Okay. Now we're gonna kind of start getting into the volume profile. A lot of you guys are familiar with the volume that kind of looks, it's vertical lines on the bottom, and that's just how much volume at that time happened, right? So that's good. I'm not saying that's a bad one. I do keep that volume as well. But what really gives up a lot of information for us when we are trading is at what price level did we trade the most volume? And that's what volume profile kind of helps us. It's the horizontal lines that you see on the charts. And there's certain components of volume profile like POC, value area high, value area low, and we'll cover all of those in here. But they give us a message at what key points did we trade the most volume, the least volume, where there was no liquidity, where it was high liquidity, chop zones. So we're able to identify those just by looking the volume profile. And I started adding some stuff here for volume profile for dependencies, which is, I would say, the final level of trading for volume profile is finding the market structure and able to read what is the market telling you in terms of the different sessions for volume profiles, the daily sessions, and how you can use it to kind of help you with the conviction of the trades, right? And like the last bullet says, so depending on the volume, volume profile will derive at different shapes, right? And we cover all the shapes in this training. So hopefully by the end of the training, you guys will be more familiar with it. When you look at volume profile, it's important that you understand kind of the shape of it, right? So when we chart, especially in this Discord, when we look at the value areas, right, we set ours as 68% just because you can't use decimal points, but 68.2 is the first standard deviation is the 68.2 in the bell curve. So if you think about statistics, right, if you flip a coin 10 times, there's a high chance you're going to be nailing it right there at 50-50. So when you look at statistics, if 68% of the volume occurs in the value area, those areas, the tops and the bottoms, value area high, value area low, they will act as magnets and really strong support and resistance points on both ends. So it's important that that we find them, especially when you're using daily, weeklies, and different kind of the ranges, periodic volume profiles. it's important that we identify them, and it's hopefully with with this graphic here, you guys can understand why we use the 68% as a value area. So here's kind of the explanation of the value area. If you guys are looking at the volume profile here, it's nothing else but where 68% of the volume traded for that day. So in this case, right, it was between 295. This is Qs from way back September. So this is, excuse me, I'm still jet lagged. Still wake up at 4. Value area high here and a value area low. And that's literally just means the extreme high price and extreme low price of the value area. And usually when the price goes inside the value areas, like here, it's not finding much value below. So the buyers are becoming kind of responsible here and buying it and driving it, of course, to the POC here, the red line. And then, of course, we can go all the way to the value area high, which helps us identify a certain type of place, right? So how if the value area is pretty wide, it suggests that there's a lot of participants and traders in that session, right? So usually when that happens, there's probably not a lot of direction that can be determined just because it's a wide range, right? And if it's a low or narrow range, that means there's not a lot of activity. And usually from those narrow activities, narrow shapes, we usually get a nice little pop just because once we find that imbalance or the news or something drives it, it usually pushes the price to the next closest value area. So that's the highlighted piece.
Shorty?
Yep.
Can it happen that 68.2% value area can be on the extremes of the price for that particular session or the period, or it will always be in the middle, close to middle?
Oh, I mean, of course. So value area high is your extreme, value area low is your extreme low.
No, I
So the
mean,
price can, yeah.
I get that. That's the value area. But if the overall price movement is from 70 to 80, assuming the value area will be somewhere between 73 to 77, I'm saying, can it also happen that the value area can be from 70 to 73, like on the extreme of that price?
So you're saying if the volume is so concentrated, like a perfect distribution, it can, but statistically, you will still always find a 68%. If you can find 77, your 68 is also going to be calculated, right?
Because
It's just
I
your
saw
first
some
standard.
anomaly in previous week. I'll talk about it when you cover
Okay,
ES.
yeah, sure.
Thank you.
So this slide here, I strongly suggest that you guys print this out. And if you're trading volume profile, that you print it out and let this derive your bias for the day or for the week or whatever that might be, just that you don't drive your bias on the day from feelings, right? So if the stock price opens above the value area, right, and then it fails back inside the value area, this is a strong bearish signal. This is important because a lot of times, especially lately, for past 4 months, I would say that a lot of the moves that we've had, they happen after hours. By the time it comes to us in a New York session, if you're not trading futures, you're like, man, the whole move happened, but it still gives you a little bit of clues. So always pay attention to the previous value area. If we open above the value area and then the fall back inside, that's bearish. If the stock opens below the value area and then it rallies back inside the value area, it's accepted. That's a strong bullish sign, and that from these we can derive a couple of plays like 80%. A couple of Wyckoff TRE plays as well. And then if the stock price opens below the value area and continues to stay below, this is kind of institutional buying and selling because they're not letting the retracements happen. Usually you will expect the price to follow through and keep going higher or lower dependent, where we open. So that's the last bullet. Any questions on this slide by anyone? Can you guys visualize this as I'm speaking if you're fairly new or not?
Yes.
No, perfect. Okay, so volume point of control. This is let me go to the next slide here. So kind of talk about, so if you think about the red line there, same chart, this is the highest volume traded there. So that level there alone is going to be acting as a magnet for the price, right? Price is going to navigate towards that level at any point. just because there's a lot of volume there. There's a lot of buyers and sellers around that area, and they're pretty happy to trade in that area. That's the equilibrium of the value area. Excuse me. So whenever that happens, if you're, let's say, stuck in a range for the day, and you're looking at value area high, just like I think we did on Friday, we shorted the value area high and kind of get out of the POC of the subset that we were looking at. Same can be done on a daily and the smaller time frames. When you go to value area high and you haven't been able to break that level, it's not a bad idea to short the value area high and get out of it, that short position towards POC. If we slice through the POC for some reason, without stopping, then, you can move your stop down, right, and drive it all the way to value area low. But at least you have 3 levels that you can play ping pong and move your price targets and stop losses around. If you look at this chart, I'm kind of shifted the bell curve to the, to the right, and just kind of show you the standard deviation presented inside the value area, and then of course the POC being right there. Okay, any questions here?
Very quick question.
Sure.
For Thursday, you know that the previous day high, it's already met when you actually opened the market on Friday last week, and it reaches previous day value high. Do you automatically pretty much enter the trade and take the loss 20 if it actually goes higher?
Not necessarily, right? So if you're, usually there's 2 signs, right? So if you open above PDPOC, the previous POC, that's usually a little bit of bullish. And if you open above the value area high, that's extremely bullish when you have 2 of those, right? If you're above value area high, most likely you're above the PDPOC. But if you open above POC and you go to the value area high, then the question is, have we been trading in this range before? If we have, and we had some rejections, then you can enter the short, right? Ideally, what you want them to do is to go above the value area high and then drop back inside, because that would tell you that they rejected the price and they're not finding any value above that value area. That's usually the best scenario for shorting. At least the least riskiest for you to short it.
Yeah, that's
And
exactly what you explained. Yeah, it's at the
which
pop. Yeah, that's it.
It would institute the 80% rule, right? So the odds would be in your favor to take that trade. And we'll cover an example that talks about it. Let's see. Did I just skip a couple of? Okay. So I don't know how this slide moved in. So volume profile types. So if you guys know, we use different types. So we have the fixed range, which is basically you're grabbing a point A and point B. You're really interested in one point of data that you're kind of trying to go after. So I'm just going to kind of hop in here and show you. So if you look here right now, let me just hide this. So if I look at the 30 minutes and I'm like, man, I just want to know where's the lot of volume here. I see there's an imbalance. We point down, impulsive move. I'm interested in this area right here, all the way, let's say, to the bottom. So if I look at that, this is going to tell me that a lot of volume was concentrated here, right? So if you're able to kind of go over 39.30, I would expect the price to kind of slowly chop up, right? And go higher. So the acceptance here would be that we go above here, and then you have this little chop here, and then it would probably explode to this area here. So that's a bullish scenario, right? But I'm only looking at a piece of data. I'm looking from Tuesday, December 13th to Friday, right? And you can extend this all the way to the right. But usually what I do when I look at, fixed volume profiles, if you look at it on a daily, you can kind of get a little bit more picture, right? So if you go here, you see that we consolidated. We are in balance for some time here, right? So I would say, this whole thing here, we're in balance, and then we popped lower. There's an imbalance move. Not a lot of follow through yet, especially, I guess, with today's session that's there. So what I'd like to do is, if this is to hold overnight, this is not a bad idea to kind of mark this and look at this level here. If you're able to push to 4,000 on ES right here, this would be a good short, right? And then you also have the structure low, which is kind of sitting right here. which is, what is this, 39, almost 50. So this is your POC with the sell-off where a lot of volume was accumulated, and then you have the structure low. So these will be the two entries that you'll be looking to short based on the fixed volume profile. And then from here, we talked about you will have the visible range. So the visible range, I don't think I have it. So let me go grab it. If you look at the visible range volume profile, so that's the last one here. If you go under indicators, technicals, volume profile. So this one is basically going to show if I kind of keep scrolling to the left, whatever candles are visible, it's going to calculate that POC for you. So right now, I'm looking at the data from April 28th all the way to current, and it's saying that all of that data, the POC is right kind of at 3996 at 4,000, right? So if you're able to, if you think about this, right, we broke this POC now. So now if you drive it back up here, this is a really good short, because that means you pop below it and you're coming back for a retest, and that's usually a really, really good short that we can handle. So that's visible range volume profile, and then session volume profile is what we use a lot, and we use that on 30 minutes. So if I go here,
Jaden, you still need to get your target bag.
and somebody forgot the target back.
Handled.
Thank you. So now if you look at this session volume profile, right, we mark a couple of things, right? So here's your PD POC, your PD value area highs right here, value area lows here. And then you kind of look at the shapes of the volume profiles and you're able to digest some of the stuff, right? Like a long B shape here, and then you have almost like a double distribution here, long B here, and then I don't know, I would call this also a long B here at the bottom. This one doesn't matter just because it's being developed. I do not care too much about developing POCs for the day, just because the days, especially the beginning of the day, it's too early and you're not able to trust those levels. So I don't use those levels too much. And then PVP, this is something you guys can probably get really creative with this. Is basically you're setting that whatever you want it to be. If you're using monthly volume profile, if I want to see it for the month, I would just have to go enable this here monthly, and I usually look at this on 4 hours. So here's my month of December, here's my November. And what do you guys see here? Just quickly, if you look at my November value area, where are we bouncing? Right at the November value area. We're trying to hold the November value area. Otherwise, we might go to the October and get a bounce from there, right? So I think we had this happen here last time when we popped under here. I forgot what month, maybe it was September or something. We had a really good scenario last maybe a couple of months where it broke below one value area of the monthlies and then the bounce of the previous value area high. And here it's holding that November value area right now. So let's see what they do. If they're able to go below it and reject it, that opens up the doors to potentially 38.40 here. And then you guys see that, what is this? October is a VPOC month right now. So this would be a VPOC on the monthly scale. So VPOC October here. Let me just kind of move this to the right. From new people here, what would the VPOC stand versus the POC? Does anyone can imagine what that would be? Don't answer if you've been here. You should know it by now.
That's no fun, shorty.
Yeah, as far as I understood,
Urgent POC.
if the calendar, sorry, if the candle has just hit that point and went back up and never come back and tested that level and went down, that is called VPOC. Or
That is
POC.
correct. So it's basically an untested POC. So if you guys look, for instance, this is a larger scale. This is a swinging setups based on the monthly profile. So this POC here, once we left it, we never came back to it. So that means it's a virgin POC or naked POC. And these are probably 10 times stronger than the regular POCs If you think about like trading based on volume profiles, if you have a session POC that's been tapped before and you have a VPOC, the VPOC is going to have 10 times more power on it. Okay. Just something to notice here. I would keep this right here. If you guys look at this level, that 39.92, and you kind of draw a little demand zone around it, or sorry, zone around it. This is pretty much a double POC so far. We've traded at this level so heavy that you have November and December POC perfectly lined up here. And that's usually pretty powerful. If we do decide to go back up, which is about, 100 points away. If we do go back up, this would be a really, really good short level. Like a beautiful short level here, okay? Let me go back. So we covered all of these, and then I kind of give you the guidelines. If you're using monthly PVP, use 4-hour time frame, weekly, use 1 hour. So hopefully that can help you. Let me go back in presentation mode. So if you think about, the visual breakdown, the volume profile, we kind of touched points on all of these. Point of control, highest volume traded, profile low, that's just your low of the day, profile high, high of the day. And then you have the value area high, which is the value extreme of the value area, and the value area low. And inside the volume profile, let me see if I don't. There's something called HVN. I'll probably add that here just to make sure we have it documented. It's the high volume nodes basically. So if you look at this profile here, I'll actually find a better example. And the low volume nodes. So let me go here, kind of go live here. Let me delete. So if I look at this, for instance, let's just do this. So here, if you guys look at this volume profile, so these nodes right here that you guys are seeing, right? These are kind of like high volume nodes that we are stuck in here. And you guys see here, we came back to that 4180 right here level. We hit it on the dot. And then we came back down through the skinny belly, which is a low volume node. There's no liquidity here. There's not a lot of volume. So whenever that happens, you're going to fly through it. We also call those skinny bellies, right? And then high volume nodes are here. Usually the price will chop as you guys see it, like right here. The price is going up, down, down, up, down. They're building a lot of kind of liquidity in that area. So there's a lot of volume here being, if you're able to break, let's say, below this level right here, 3615, there's a high chance that we will probably go to about 30, whatever this is, 3400. And then, obviously if we keep breaking down, you will see this now volume kind of shift and really tells you the next true volume node sitting around 2900. So that's how you can use the high volume nodes and low volume nodes just to identify your supply and demands and potential support levels and resistance. Okay. So that's the high volume nodes. I did add them here, and then the low volume nodes, so which I basically just gave you the visual for. Any questions so far on the breaking down of the volume profile and everything on it? Okay. Next is the volume profile shapes and the meaning of each one of them. So usually, like I mentioned in the first slide, stock market will spend probably 90% of its time in balance, meaning they're going to be in what type of day here? It'll probably be
sideways.
It's probably going to be number 3 for 75% of it, and then the remaining would be probably sideways that we're going to get. This is probably it's called typical because it's the most typical day. Usually the characteristics of this is a wide initial balance and then kind of just lower highs. It really never takes out an initial high that's set or initial low. It just kind of trades in between. And it has a wide balance, and that's the difference between this one and sideways. Sideways does not have a wide balance, and it's just horrific to trade. I mean, if you see something like this, it's just better not to trade. So if you identify this between 9:30 and 10:30 that the balance is pretty tight, excuse me, most likely it's going to be a sideways day unless there's news or catalyst that we're waiting, like FMOC or CPI data or something being released where it can pop through it, right? Or have a trending there. Or from that, you could kind of derive into double distribution day where you have a value area or a high volume node on the top. Then you break that into a skinny belly and then you find new value area. And from this area, you can go back up or you continue down, but it would be double distribution trend day that you would have. On trend days here, so this is, in this case, this is a bullish trend day. The opening candle is usually candles low, and that market then gradually moves higher throughout the day. So you're really not making any lower lows. You're making higher highs and higher lows, and you just keep going. The same would be true if it was a bearish setup. It would be lower highs plus lower lows, and you're really, the low of the day, the opening would be the low. I'm sorry, the high, and then it would continue down. Expanded typical day, sometimes this is a really good setup to trade. If you guys see that we have, not as wide balance as a typical day, and we see this, and how can you kind of tell, hey, Shorty, that's kind of tough. Well, I mean, if you just take 7 days or 10 days and you quickly calculate the high and low percentages of the day, and you see how many points you had, you can quickly calculate where it falls so you know what type of day we're having, right? So a moderate initial balance here, it's not as wide as typical day. That means there's room to either break it higher or lower. And usually this typical day gets broken between 2 o'clock to 4 p.m. You'll know if it's going to be a typical day. And, don't quote me on that. I've seen them break from typical to extended at 355 by a margin, meaning they literally dumped it in 5 minutes. People have been waiting all day and they dump it to 5 minutes prior to close. So these days types are represented also on volume profile. So if you think about it, right? So let me just talk about this piece here. So hopefully you guys understand IBH and IBL. There's a whole section that I have on the PDF on the day types and, setting these. The best way and the quickest way to kind of figure this out is, look at the 9:30 a.m. to 10:30, mark the highest high, mark the lowest low, and that put it as initial balance high, initial balance. And then it's just some rules. If the 3 5-minute candles, whatever you're using, closes above IBH, after the 10:30, after that 1 hour New York session is open, then there's 88% chance that the low of the New York session was the low of the day. So how could you use this? This is very good information to have, because if we know the low of the day that we already set in that 1 hour is the low for the remainder of the session, then every time we come to it, or we find a high volume node in between, you can go long there and expect it to go higher, at least to the high of the day, but we know it won't break the low of the day with 88% chance. And same is true for opposite. Okay, so D-shaped volume profile. So this is your, since we talked about the typical days, D-shape is your typical day. So most likely it's a perfect, bell curve that you have. And the POC is usually at the 50%. If you're to take the high and the low, the POC is at the 50% fib retracement. This would be choppy, and you have to be quick on profits. And you want to, if you're not familiar with trading ranges, you want to avoid trading this day kind of altogether, especially if it turns from, like a nice D range profile to a sideways day. Sideways, especially if you're fairly new, suggest that you don't trade it. People go heavier on contracts. They double down, and then the price just kind of theta does its own thing, and basically you end up hurting a lot more, even if the price goes into your direction, just because it's not moving really fast. So how to trade that? That means the market is in balance. You short the highs and you buy the lows. And if you look at the bottom bullets here, responsive buyers and sellers will be present on the high and the low of the day. Once you know the volume profile shape, correlate that immediately with the day type. You short the highs, buy the lows, with POC being your exit. So if you're shorting value area high or the high of the day, you want to know where the 50% or the POC is, so you know where you should get out with your long or short. Any questions on this? This is probably the easiest day to trade.
That was one of my questions that I had is that I thought you had mentioned like we want to avoid it, but it's also easy. There's like a fake out that we have to kind of look for there, or
So
is that
when
really
I
too
say if
difficult?
you're fairly new and so the where when I say avoid it, if you're fairly new to options and you don't know how the pricing of the option works, meaning like the theta, the Greeks and what they can do to your contract. If you're a lot of traders when they get into options trading, they're expecting these massive moves of, sometimes they nail that 200-300% play and they expect it every day. It's in their head. The stock market will not reward you. It will humble you out of those 200-300% quickly. And what I mean by that, until you psychologically figure out how to trade these balances, being happy with 10, 15, 20% on a trade is good. And it becomes easy when you're, mentally ready to accept 15% win or 20% win. If you're expecting 100% win on a typical and a D-shaped volume profile, it's going to be really, really hard for you to trade because most likely what you're going to do is you're going to double down, you're going to blow up your account chasing, and the theta, they're just going to be saying thank you because you're going to be trading, in a really slow price action, but you're going to be expecting some crazy returns. And when you're up 15%, you're not going to take the profits. And usually, people start averaging down to, losing positions, not their winning ones. So that's that. From that perspective, I say it's hard. Once you figure out, your greed levels, and you figure out, that you can compound your account much quicker than a lottery style, it becomes very easy to trade. It's actually my favorite to trade is the range days, right? Because you can short the highs, buy the lows, and let the market do it for you. But you have to be a little bit quicker on profits.
That's super helpful because that's exactly, Shorty, what has happened to me. I've gotten burned because of that. I didn't take and I didn't understand how much the theta would kill me, and I've lost more when I thought, I went from being ahead to losing a lot.
Yeah, and that's mainly driven because it looks easy, right? And then you're like, oh crap, man, I was up 15%. Let me just add more and I'll equal it out, right? And then you add, and you're like, oh crap, man, the day is over and we barely moved the price, and all they did is 8-year contract. So that's why I'd say it's hard until people realize you can compound your account with 10-15%. I mean, if you can do 10% daily on every trade that you take, you'll be a millionaire in no time.
Shorty, quick question.
Mhm.
Since this volume will be developing early in the day at open, at what time is the best time to decide, okay, at what type of a day it is?
You will know between 9:30 and 10:30 what type of day you're having. Usually no later than noon.
Okay.
Yep. If they drag it past noon, that's usually something is off or market's waiting for something. Yeah. Between 9:30 and 10:30 a.m. is the highest volatility. And then you have the 11 o'clock when Europe closes. So usually in that time frame, you should know what type of day you're having. And once you identify the type of day you're having, I promise your trading just got 50% better. And a lot of people that are in this room trading, once they see the type of day, you're able to kind of make some assumptions, especially once you figure out, the volume profile, the previous day, how was it, where's the value area high, low, you're able to kind of make some not emotional decisions, but rather like statistical decisions to help you with the trade that you're taking.
Okay. Thank you.
So P-shaped. So this only occurs, well, there's two ways that it can occur, right? So usually you want to see this as you're going up. If you're moving up, this is good to see in the uptrend because it means that, the bid was really aggressive and that's, they're driving the price from the bottom through the skinny areas of volume. And then they come to a point where they're kind of consolidating and accepting that value area and they're creating that within the value area of that P-shaped volume profile. What sometimes happens, it happened, a couple of times if you guys look at on SPY on ES, when a P shape occurs on the bottom of the chart, that usually signifies it's a short covering rally. That means you're going to get a little pop, right? You have to look for the next supply where it's going to go to, but usually means you're going to get a little pop due to short covering rally. Uh, it'll go higher, right? But it's not a true buying opportunity that it needs to shift from. Usually if you want to see, kind of buying occurring and driving the price up, you should not be seeing a P shape on a bottom trend. You need to go from lowercase b to kind of B shape, D shape, D shape, D shape, and then, a few P shapes just to test the market, see if they're willing to accept it, and then come back to the area where they consolidated and then drive it from there. So that's what you want to see. But when you see a P shape and a uptrend, that's usually good. You can play that to your advantage. If you break the POC, and depending on where you close on the P shape, right? If you close, in this case, if you close above 50%, that's higher chance that you're going to break the high of the day the next day. And then on the lowercase b, if you run the fibs and you close below the 50%, there's a high chance that you're going to be going lower and breaking the previous day low as well. That's in the notes here. Already covered the two of them. Any questions? Okay. So when you do trade P-shaped volume profiles, for instance, like this, if you see it, let's say last week on Friday, we had a P shape, and then the price, let's say breaks the value area, but there's a high volume node that's sitting right below it. There's a strong opportunity that you can buy it at the high volume nodes. So for instance, here, you had a really strong POC at the top, and we closed. If you look at, let's say, if this was the close of the day, you closed above the POC and closed a high of the day. When that happens, there's usually a high probability you're going to go higher, in terms of the market structure and knowing how to define that. So if this POC, let's say the next day you drop from here, you lose this POC, which was pretty high up there. This volume node here that's inside the value area would be a good one to go along here, right? So you see them here, drop it, they came back and drove it back up. And then if it was to drop below the value area, this volume node here is pretty significant here, because you see them, they're driving the price up. They created a nice little, bell curve here. Then they drove it, they re-added at this position, right? So if you're able to drive this price down here, what do you think these buyers will do? They will defend their levels, right? They will defend their positions. So what you would do is you would, if the price comes back to this level, you hop in with them and ride the price higher to the next high volume node, which should be, let's say, in this case here, and you exit your positions. It doesn't mean you're going to make 100%, but it means that your setup that you're trading is highly probable. And if you can do that thing over and over, same setups and high probabilities, you become a profitable trader, and that's what you're aiming for. Okay. Any questions on this? Okay. So just like, we talked about P shape, everything's this opposite for the B shape volume, a lowercase b shape volume profile here. So like I mentioned, if you look at the highlighted, if the price closes above the 50% fib on the day's range on the B shape, the trend would be more debatable the next day. Probably will not continue. If the price closes below that 50%, there's a higher chance it's going to continue down, and then you can use the POC to try to figure out, where we are and where we can expect the rejection to be. And it's identical setups and trading. Just flip it, and you're trading high volume nodes for shorting. Instead of going long, you're looking for high volume nodes. If they push it up, you can short it. For instance, if you looked at here, you draw it all the way to the right, you see that they were not able to literally break this high volume node here. And usually when you draw the high volume nodes, don't draw it like a single line here. I usually grab nice little distribution, if it has even distribution between them, to grab that and kind of trade it like that instead of just a single level. Okay. And just like P shapes, B shapes are found in the downtrend markets, right? So if it's in an uptrend and you see a lowercase b in an uptrend, that's probably signifying a reversal. And that's something that you can pay attention when you look at the market structures. And if you study this a little bit on your own, which I strongly suggest you do, you backtest it and you see it, you'll notice it a few times, right? And just like anything in the trading, it's not 100%. Not every time you see a B shape in an uptrend, it's going to be a reversal. Otherwise, it would be too easy to trade, and everybody would be like, oh, look, it's a B shape in uptrend, time to short. Well, you're going to have traps, right? And that's why it's important to use a stop loss on every one of these trades, because you're playing the probabilities. You're not playing the guarantees that you're going to make money. So the odds are in your favor, but if they're not, make sure you keep your capital. That's the rule of the game. Okay. All right, so B shape, so uppercase B, what this signifies is basically it's a double distribution date. So if you think from those 6 date types, this is your double distribution day. Sometimes it can be triple, quadruple, depends how choppy the price is. In this case, you know, you want to be playing in between them, right? So whenever there's a skinny belly in between the price action, you want to be playing that, right? So here they rejected it. Once we broke that, you know, high volume node level here, you basically went to the next one, consolidated here, and flew to the next one here that you have. So this is a pretty good day to play just because you know where the price is going to accelerate quickly. So it's really good to use this actually if you can find a B-shaped volume profile for the day or like a double distribution day to use that and trade it. So like I said, it's kind of like a ping pong. You play through the skinny areas, you know, you short it here, go long here, and so on. This is a really good, if you can have this day, it gives you a nice little range and you can get nice little trends in between just because the skinny bellies. Okay. Any questions on volume profile shapes that we covered? So you have the P, you have the B shape, and then the D shape and a capital B. Okay. I do suggest that you go and chart it and you look at it and kind of see if there's any dependencies on them. I'm adding some stuff here in our PowerPoint here for the dependencies. Hopefully you guys can start spotting some of them on your own if you're looking at the day sessions, right? So if you look at this support and resistance, I'm just adding this because it does leading to the setups that we play. So if you look at this, you know, you have support, and then it happens the SR flip, right? So once the support's broken, not necessarily do I like to short immediately here like a momentum trader. I like for it to come back on a retest. If I see that, you know, we're going to have a flush or see aggressive sellers coming in, yeah, it's not bad to take a trade here, keep a tight stop loss above somewhere based on volume profile or whatever you're using. Put a stop loss there, but you know, the retests usually give me a little bit better picture of what I can make, right? So if I know I'm shorting here and this was the previous low, you can pretty much set your profit target at the low here. At least I know where the buyers are and sellers are so I can get out, okay? So this is really, really good that you can use on the SR flips and play the retests of them. So here's the opposite, right? So you had the resistance here. This was support. And you see here, once we broke this resistance here, we came back and boom, that was the entry. And now you're able to kind of figure out, you know, where do we go from there? And if I'm adding a little piece of information here. It's called the measured move of consolidation. So if you think about this was, you know, 10.38%, the consolidation zone. And if you went long here, basically what you do is you grab from this point onwards, you will find the same distance, try to match about here. You went to 1039, and this would be your target for first entry to close. As you get better in your trading, you'll be able to hold the winners much longer than your losers. At the beginning, you guys will suffer like every one of us. You're going to be doing the opposite. You're going to be holding losers and selling winners quickly because you're in a, you know, you have a snake bite. You're going to be trying to revenge trade, try to grow your account back to recover your losses. Instead, you should focus on the process rather than the money. So once you nail the process like this, the money will come quickly. You know, you don't need many trades to recover your losses. Once your process is high probability setups, you can repeat that process as, you know, as many times as you see it, and the odds will be in your favor. If you focus so much on recovering your account, you will not do well because it's going to impede with your mental side of kind of growing and learning how to trade. I'm adding here because I do use candles. If I see a couple of candle types of informations like the pin bar candles, I use more than pin bars, you know, from the candle types. You have to learn how to read a little bit of candles. you know, whether it's a piercing candle, a hammer, a doji, gravestone, um, you have to be able to read the price action of the candle itself, whether it's making higher highs, lower highs, the spread of the candle, how was the volume, was it supporting that candle? Some of those things I'll mention, but these candle, the pin bars at least here that I'm mentioning, they're really important if you find them at support and resistances, because it does tell you a lot about the, you know, the aggressiveness and the reversal and how it works. So if you think about the, you know, the lower wick example here, the price, you know, started opening high, right? And then they pushed it back down, right? You have the open, then you have the selling pressure. And then what happens? You get the buying pressure. So what would that mean to you if you find this at support? Is that, well, you know, they drove the price lower and they got exhausted. The buyers were not willing to let the price go lower. They're able to push the price back up almost close to the price where we opened, hence the small bodies created there. And then if you look at the volume on the vertical sides, you'll be able to kind of figure out if it's the exhaustion volume or if it's kind of reversal volume that we are seeing, stopping volume or not. Okay. In the next slide, that's kind of what I explained. So if you have a lower wick example here, you have the open, you have the selling pressure, the lowest set, then you have the buying and you close there. So that's the lower wick example here. And then you have the upper wick example, which would just be the kind of the flipped, right? So you have the buying there. Sorry. So you have the buying here. They get kind of exhausted here. Buying exhausted, and then the selling pressure hits and they drive it back to the opening price, and that's how you get the upper wick. Okay. This is straight from the Dale's book, the pin bar examples. So this is a strong high.
I lost money that.
I'm sorry?
No, don't worry. I just unmuted somebody, but their mic's still alive.
So a pin bar example, so a strong high rejection here. So if you have a price and from that price we get an instant reaction of the price, meaning you get an impulse move there, that means it's usually a strong high price. That means that there's a lot of sellers sitting there and they're fairly aggressive in terms of how quickly they want to get rid of the equity or whatever the, you know, instrument is. So here, if you look at it, you know, the pin bar was present right at the resistance. We kind of drove the, I don't know why it keeps doing that. We drove the price lower, right? We broke that structure here, and then we kind of created a little bit of, you know, consolidation here, and then we drove the price back to the, you know, to the crime scene. At this point, you know, since not many maybe sellers got filled here, you're going to be joining them on the first step here. And usually that's pretty good, you know, to hit the next low here or previous low here to put that target right there. And you would drive that from here to here. Much easier to drive it from on momentum break from here to here, but this requires patience, right? You will have to look at this compression and kind of sit through it and wait patiently for it to arrive here and then push it back down. So that's your pin bars. This setup here is, you know, it's been my bread and butter setup here. If you're looking, you know, if you're to trade one setup, this is probably the setup to look at. You'll have to figure out what works for you, whether you're looking for accumulations on 65, 30, 15 minutes for intraday, or excuse me, if you're looking at daily charts or weekly for potential swings or monthlies to find, you know, higher picture stuff, right? So if you're, you know, you're not looking only at trees, you would kind of look at the whole forest and see, hey, what's going on here? I'll explain that, you know, on both of these setups. And once we do the watch list, we'll look for this to see where it's sitting. So that way we know, you know, the short or long levels. Okay, so the three setups that we kind of focus on a lot is the value area is the 80% rule, just because it has 80% winning chance. Then we have the accumulation setup, right, that we look for, that I said it's the bread and butter for me. I focus on that a lot. And then the old support, new resistance, and vice versa, right? That's the old school stuff, but it really works, still valid. You're looking for old support becoming, you know, resistances, and resistances becoming support. And you're trying to play that. And when you overlay, excuse me, guys, man. When you overlay volume profile over that and some levels line up like POC on those support or resistance levels, it becomes so much easier to kind of play and trust the setup that you're seeing. So some scenarios and value areas. So we talked about the volume profile. So this now you're going to be looking at how do you trade it properly, right? So if you guys think about this, right? So value area examples here. If we try to go outside the value area and tend to come back inside the value area, this is a good opportunity to short, with POC being our first target. So if you think about this example, we went above the value area, right? So this line is value area high, value area low, the POC. You went above it, and somebody asked the question, do I short it immediately as we come up to the value area high? If you shorted it here, you would have been stopped out most likely, and you would have lost some money in a trade, even though it's not the most highly probable trade, but it's better if they go above the value area high and they drop back inside and you short the retest of the value area high. It's much more probable here than it is here for shorting. And then you would have the POC as the first target. And then, you know, the value area low of the previous session would be your next target. Does that scenario ring a bell to anyone? Anyone seen it before? No. Okay. Value areas, acceptance of new area. So if you're trading, and this can be, you know, bullish or bearish, to just in your mind be able to flip it. So here, if you try to go outside the value area and, you know, you're having a nice trend day, and you're tracing back to the value area high, this is the zone where you're trying to go long. So dependent on your entry criteria, right? Whether it's the tape or the candle formations, or, you know, breadth indicators that, you know, you use, whether it's VIX or whatever that might be, you're looking for the retest here of the value area high for the acceptance to see if the being outside of this area is being accepted, and that they're going to go look for, you know, new discovery, find new value area. Okay. So that's just the acceptance. So this here is something that we talked about earlier when I talked about values, tips, and tricks, right? So if you think about this, you know, you dropped outside below the value area. Now let's say the new session starts right here, and you're able to regain that value area session. You know, momentum traders might take this if you're trading volume profile. Man, the jet lag is real. But in this scenario here, you drop below the value area, you come back inside, and you come back for the retest. That's telling you a lot. That's telling you that the value area here is being accepted, and the first targets are POC, second value area high. Does this make sense?
Yes.
Okay. So here, you know, how would you trade this if you have the POC? There's multiple ways, you know, in this scenario to trade it. I'm not going to go over it. I gave you one easy one where you could take a little bit aggressive one here, but there's a few ways you could trade this, and hopefully you guys can take a look at it. You know, if you have questions, you can send it to me, post it in the chat. But it will help you to kind of draw the scenarios out. There's a handful of scenarios you can have on the value area, where, you know, drop below, accept, go long, POC, value area high, go above, drop inside, short, right? So there's a handful of scenarios you can play, and you should be able to visualize that rather quickly, that you can kind of recognize it and go, whoa, well, I got it. Accumulation setup. So this is a massive, you know, time frame that I grabbed for Oxy. So when it was, you know, it went up, you know, when they had the, what was it? Warren Buffett, you know, when he was buying it, we exploded much higher. And then this is where we entered our kind of like a swing position right here. And the reason why we entered here is at this POC, you can see how many times we accumulated at this price right here. So we accumulated a lot, and then we created an imbalance from it, right? So it was an impulsive move from it. So my goal was to hop in this trade, and we did. Right here, and drive it at least to the top of this volume node, which was right here, kind of where we got out. So it was a planned trade. We had, you know, proper entry, we had the loss identified, and then we had the targets identified. And once you have those three identified, in every trade that you do, it's much easier to trade. It's less stress, and you know what you're looking for. And most likely than not, when you do playing like this, you're gonna respect your stop loss. And then when you enter blindly, whether it's somebody's call out or whatever you're doing, you get in a trade and you don't know why you get in. Well, if you don't know why you get in, how will you know where to get out? Whether it's profit or loss, you will be clueless. You will not know where to get out. Okay. So plan your trades, identify your entry, stop loss, profit target in that order as well. This is the bearish example. So this one is a little bit different. And there's a reason why I posted this one, because I believe this was SPY. It is SPY. So here you guys see that we accumulated on this area here. We came here. They, look at the candles. That's why I say more confluences, the better. They gave you a pin bar here. They made a lower low here based on a pin bar, and then they reversed it. It went to the value area high. But then once you drop below the POC, remember, a lot of people can, you can definitely short this right here. And you'll have to know, the volume nodes like this one right here and this volume node here, that you're gonna have to respect it and exit your shorts. But look at this. You break the, this POC, this is pretty massive. April to October, so a lot of data. Once you break this POC, look where you came back to reject. You came back right to the POC. And from there, I mean, you got a nice little flush. I mean, you got 40 points here and then, some more here, about 60 points total. So this POC was the bearish setup. It's just they set up a trap. You would have been stopped out here. And then once you broke below it, same scenario. You get a short here, maybe put the stop loss around 418 and go from there. So now you have 7%, 7 points stop loss. And if your first target, let's say it was, 100. So you have 7 points stop loss, maybe it's too high for 11 points target. Or if your value area low was a target, if you're really patient and bought contracts further out, then it would do well, right? You was short here, even if it's 10 points stop loss, right about 420. So 10 points stop loss for about 30, 40 point gain. That's a pretty good risk reward trade. Same setup, just on the bear side.
Quick
Then
question
here's
on
some.
that. That looks like a daily chart.
Yeah, this is bigger chart.
So if you're on SPY and you're trading options, are you looking to what expiration are you looking at when you enter that?
So if I trade on a daily volume profile, I would usually look to 4 to 6 weeks.
Okay.
So on a daily 4 to 6 weeks, if it's weekly candles, weekly volume profile, I'm grabbing a lot more data. Usually you would need, 3 months. And then if you're looking at monthly volume profile, that means kind of like leaps. You're buying stuff, for holding or buying shares, for instance. Right. For me, AMD at 50 is great. AMU for me at 50 is great. So, you can buy leaps, 10, 15 points out and almost guaranteed that you're going to make some money on those. You just have to sit and be patient.
Okay. Thank you.
So here's a quick bearish example. We're just looking at swing high here, swing low here. I was trying to kind of figure out what's going on here, right? I was grabbing this point of data. There was an imbalance. From this point, they made a lower low. They broke the structure. And then once they came back to it, they're able to short it. And this was pretty good to short because you went back to that range bottom. So about, 30 points short on ES is pretty good reward. Okay. This setup includes 2 of our setups, which is kind of like, you have the support and resistance. And also the VP supporting this because this is our value area low, right? So value area low and value area highs are strong support and resistance points. So in this case here, this was a nice, if you look at this, it was a nice support resistance here, acted as support, it broke it. So as you approach this level, and I forgot what this Caterpillar, as you approach this level here, this is a pretty good short. It's a value area low. You broke that initially, so now you're coming back for a retest along with being SR flip. It's not a bad opportunity to get in a short, place a stop loss above or based on your risk. And have a swing entry on this just because it's 4 hours, you know, maybe 2 to 4 weeks. Have something in there and see if you can make some money on it. Okay. You guys probably, if you're fairly new to the Discord, you heard people screaming 80% rule, right? It is 80% effective if you're trading it properly, and then there's some rules around it. So 80% rule basically, let me go here, asserts that if the stock price opens or moves above below the value area, but then returns to the value area, and usually, you know, you want 2, 5, 15-minute periods. Sometimes even if you're a little bit more risk averse, you can use 30 minutes. So if we go from the previous day, and I'll just kind of give you a visual here so you guys can, let's see. So if I go, if this is our value area here, and let's say this is our, you know, previous day value area, hey, and you open here, and you come back inside the value area high, and you're dancing here, there's a 80% chance you're gonna drive it to the previous day value area low here. All we need to wait is for these candles in here to give us a confirmation. You want 2, you know, 5 or 10 minutes. If you're really, you know, kind of risk taker, you can use 5 minutes to hold inside the value area high, and you want them consolidate. Once you break that range where, you know, you had closest like low of the day, that's not a bad entry to drive it. You know, somewhere in the middle here, you would have the POC. You can skip, kind of peel some off right here at the POC if you took it from the 80%. And if you break that POC, then your odds are really increasing that you're going to go to the value area low. If you had multiple contracts, peel some off here. And if you see it's weak, excuse me, if you see it's weak, then you can keep driving it all the way for the 80% rule. And the same is true, you know, if you're doing it from here, right? You drop below, well, maybe I should draw back again because moving does that. You drop below, you come back here, you hold it. So here, and then this would be the 80% rule on the upside, right? So you drop below the value area low, you reclaim the value area low, you know, depending on time frames and whatnot. You're trading in here, 80% chance you're going to go to the value area high from the previous day. Does that make sense? This is the best explanation I can give you. And then you can see this at work. Usually if you can find, whether it's AMD, NVIDIA, or whatever stock you're trading, I suggest you limit it to a, you know, a handful of 5 or so. And you just scan it and see which stocks have it. And if one has it, then you focus on that stock. And you would just look to kind of play that setup. And then 80%, I mean, it really can pay and really works. If you can nail 80% a couple of times a month, your account will start growing. Okay, so this is the balance to imbalance. So if you guys have heard of Wyckoff theory, right? Usually what we have, you'll have, you know, session high, like your range high, range low. And when you're going from balances, meaning if you're trading in the balance, you don't necessarily have to break the balance here. You can trade it, you know, treat it multiple ways. You can, once you break the balance here, you can short it on a retest, and that happens a lot. If it regains that kind of, what I'm saying is the balance, if it re-enters a balance and you have the POC drawn on that range and it rejects this, well, then let it drop below the value area low and short it there. Another entry is that POC, you can short it there, but this one is much more probable than that POC initially. So either one is good. This one is more beginner entry. I would most likely enter here. If you're new, this is probably an easier entry for you just because the probability would be on your side. Okay. So these are just examples. Not necessarily do I have to go through them. You kind of have to look at it, the title, and see if it kind of clicks in your head and how, you know, how it resembles to what you know and what you don't know. How do you fix that? You know, how do you fix the mindset so that way you're trading along the institutions, not against them? So I drew this a while back, you know, retail and pattern traders, how they see it. So a lot of people play, different patterns like, falling wedges or rising wedges, triangles, consolidations. You can still play those, but a lot of times, these can be easily faked out and they make them so the retail falls for it. So, and I just drew everything that I can think about that they see on a chart here. But from if you're trading volume profile, if you really study this picture, you'll be able to decipher this a little bit more. I'm not going to cover all the secrets, what you see in the volume profile, but there's a lot of information being presented here on how you could have traded this. So I won't touch this because this was the homework a month or two back for some of you or all of you, and you guys responded. So it'd be interesting to see if the new people, if you look at this chart, I'm giving you a lot of information based on volume profile here, how you would have traded this based on the volume profile and not necessarily the retail way. Okay. Volume profile settings. So I'm not going to kind of read them out here. If you're using them, all the settings are here. So you don't really have to ask anyone, just read the PowerPoint, cover this and set up your trading view if you're using that. And it's the same applicable for Thinkorswim, and we have the study posted under shared resources. So this covers basically, what kind of trader type you are. So if you're an intraday trader, you want to use the previous session as a backbone of your analysis. If you're a long-term trader, you might want to kind of analyze it on the weekly or even on the monthly zones. And it would not be bad to look at kind of the VPVR, like the composite volume profile, just so that way you have a little bit more data. So when you're trading, those levels on higher time frames mean more, whether it's demand or supply that you're looking for. The last bullet, if you're relying too much on developing POCs, I strongly suggest you kind of scale back, just because those levels have not been set and the algos haven't picked it up yet. So it usually takes about a day once it's closed, the setups, the prices have been set, that they go back into their algos and they pick them up and recalculate the levels. So just keep that in mind. This is the rules for VP. So if you kind of go through the list here, and you kind of look at the volume profile and you look at the value area and able to visually see every one of these, that means you're understanding the volume profile. If you look at this and you're not able to see and visualize all of these rules on it, then you're not ready yet. And it doesn't mean you're behind. It just means that you're taking a little bit more to pick it up. And it's not as easy as it might sound. But, take a look at this, see if you can look at the volume profile of one stock or whatever you're trading, and see if you can kind of visualize it and draw it out in your head, or kind of take a blank piece of paper and see if you can draw every one of these rules out and see what it looks like. Okay. Volume price analysis. So if you read Anna Cooling book, I kind of give you guys some key points here. A lot of people in the Discord here, when you first join the Discord, I suggest you read Anna Cooling and then you read the Dale book. Here, I'm just kind of bringing back up some of the examples, right? Because when I say a bearish volume anomaly or a bullish volume anomaly, a lot of people are like, man, what does that mean? Well, here, if you read the PowerPoint, if you attended the session, you should walk out and know what that means, right? So here, it's just kind of setting the guidelines. So if you have a high volume bar in the bottom and you have a widespread body of a candle, that means it's validated. So that's the effort and the result. So if there was a lot of effort on the volume and the result is a widespread body candle, that means it matches, right? We put in a lot of volume and we got the body of the candle to look like this. That's a bingo. That matches and you're good to go. And here, this is also true. So you have a low volume, low effort, and a low candle. That means it matches. So you did not get, for low volume, a big candle, but you got a narrow candle body and a low volume. So here, this is still validated. It's just the candles are much smaller than from the previous example. Okay. Multiple candles. So if you look at this, when you have multiple candles and the price is rising up, what we want to see is you want to see the kind of, as the body size and the candle size increases, we want to see the volume also picking up. Does this make sense so far, or you guys lost?
That's good.
Yep. And I strongly suggest that you guys read these inserts. I'm not going to read them for you, but I do suggest that you guys go back and read these to kind of understand the price and the volume, because that's the two components of the value, right? The other one is time. So this, is applicable in all time frames from 1 minute. 1 minute, you lose its credibility. I don't suggest you go below 5 minutes at first and use that. And then, as you get better, you can start using 3 minutes, 2 minutes for trading. Anomalies. So this is where we usually say, hey, we're going up, but there's not a lot of volume. So that's usually a bearish volume anomaly. Below average volume and the widespread of the body candle is pretty large. So not a lot of effort, but the candle's big. So usually that tells you something. The market's not really, the big boys are not in this price action. So that's what it says here. And there's a reason. In this case, it's the market makers and equities testing the levels of buying and selling, and therefore not committing into the move until they're sure buyers will come into the market at this price level. So basically, they're manipulating and testing to see who's in there, and they're able to drive the price with not a lot of institutional buyers backing that up, and it will result in below average volume and a widespread candle. Here, this is also kind of validation of the downside. Sometimes it can flip in your head and you might think it's wrong, but it's right. Small body, smaller candle, bodies pick up on the size. So do the candles as you're going down. It's a rising volume as price is falling. So that kind of matches and you're good to go. This is validated. Okay. So that's what I covered from volume and price from minute cooling. There's a lot more. There's exhaustions. There's different ideas and different kind of points that she makes in the book, but it's all about the volume and anomalies and price action. So if you have not read the book, it's not a bad book to buy, a hard copy, and kind of go through it, highlight it, and take notes on it.
Sorry. About where do I find the new PDF? Because the one I have doesn't have these new slides.
Yep, I'll post it after this session.
Okay, thank you.
Profile dependencies. So as I mentioned earlier, I started putting some stuff together. I have some pictures. I'm going through the charts to kind of find them so that way you guys can figure them out. There is dependencies between, the short B, the long B, the short P, and the long P. They create dependencies, who's trapped, who's not trapped, and where the price goes from there. So that's what I'm going to work on now that we're going to be slowing down in the market. I'll start putting these together, and this is really more advanced on the volume profile than what you've been taught so far. Once you start figuring out the market structure, right, you can even use a market profile instead of volume profile and see how's it looking, and are you able to figure out what the next move will be, and anticipate that. Doesn't mean kind of predict it and hope for it, but basically set up your levels and know what could happen where you could short or go long based on this information. So I'll have this hopefully for January session. I'll have this listed out. Standard deviations on the fibs. So a lot of times you guys see me using 50% and 61.8. You can also use standard deviations of the move, like the 50% of the move, the 100, the 1 to 5, and the 2. So these are the ones that I kind of care about from the standard deviations, but from the fib standpoint, as you guys know, I only use 50, 61.8, 127, and 1618. I don't use anything else. And make sure you guys are familiar with the bottom two here. If you're running up and I'm looking for a retracement, I'm going to go low to high, and I'm looking for at least 50% retracement. If you can get 31.8, that's great. That means it's aggressive. And if I'm looking for a rejection, I go high to low, and I'm looking for a rejection. Usually 61.8 acts as a good point. If you're familiar with any of the acronyms, we added some stuff here. And if you guys can think of any, just ping me, or we can add them as we grow it. But there's a lot of acronyms around volume profile, and then some of the structures, and then some typical stuff that, new high of the day, new low of the day. So you guys should be familiar with some of this stuff. Psychology. So volume profile and everything that we do is great. If you do not have the mentality, we're not going to focus too much on psychology in this session, but I strongly suggest that you kind of read through it and truly understand it, right? It's not just a graph or a sentence, but truly try to understand what it's trying to tell you. Try to figure out why you're trading. Is it a hobby? Is it money wasting activity for you? Or are you really trying to grow and become a professional trader where you're treating as a business and you feed your family or yourself from it? Once you get to that level, you really become disciplined. And until you can put some discipline, you start respecting your stop losses, your profit targets, and you're happy with compounding, you will not go far, in the trading world until you can change that mindset, right? If you haven't read Trading in the Zone book, I strongly suggest you read that book before you place many trades in the future. Just because whoever read that book in this, training class, I am pretty sure the 4 chapters, I would say, were, you feel like they were intended and like he wrote about yourself. You're probably like, man, is this guy sitting behind me while I'm trading, or what's going on? He is really good. He wrote a really good book, and he does seminars and training still. So if you're able to kind of read the book, try to document some of the stuff that you do wrong, and see, if you're journaling, and I strongly suggest that you journal your trades, because if you don't journal them, you will not know what you're doing wrong, and everything that you're doing will be useless. The journal is your mirror and a reflection of your trades and how you're growing as a trader. If you see a lot of red and you're doing the same shit over and over and you're not, fixing it, then you're just an insane trader. Like, you're gonna keep doing that. You're just gonna keep blowing accounts. If you're able to see the journal and truly understand it, like what's going wrong and why you're doing some of the things, you'll slowly be able to correct it and stop the bad behaviors. If you don't have a journal and you're just doing the same bad behaviors over and over, you're gonna really take that bad behavior and you're rewarding it with more money, new accounts, new funding. So it's gonna be really hard to get away from it as you try to become a profitable trader. So if you go through this PPT, I put this flow of acceptance and denial. A lot of you guys are in denial, where you're not accepting truly the risk that you identified for the trade. So I strongly suggest you go through this, read it, and really understand it. Just don't look at the risk like on the front page. Really try to kind of see what it's telling you in between the lines. And then this is a good tweet from my friend Market Captain, and I put it in a PowerPoint. A lot of people have FOMO about the trades, and I like how this was kind of put together, so that way you guys can kind of flow it, read it, look at it. It really hit some good points. There's some reference points, some of the books, and some of the Ninja Trader volume profiles. They have some good stuff there as well. And then Trader Dale book. Okay, so that's volume profile, the PDF, that's PowerPoint so far. I will post this after the session here so you guys can take a look at it.